Now, the Seaway pipeline reversed the flow of oil on May the 17th for the first time since it opened in 1976. Now, it will supply as much as 400,000 barrels of oil a day. That's by 2013. So the question is, how's all this increase in production going to affect gasoline exports and tanker demand in the United States? Well, let's ask Urs Dur. He is a managing director and the director of equity research at Clarkson Capital Markets. Urs, a pleasure. Thanks for coming in. I know you're getting ready for the big confab and shipping that's taking place in Greece and Piraeus. But what about shipping in the United States with this reversal of the Seaway pipeline?
Well, right now it's at 150,000 barrel capacity. It's going to feed into the refinery system in the U.S. Gulf. And in a broad sense, it's probably going to mean less crude tankers over the long term coming into the United States. But it also will mean more product export, and we became a net exporter for the first time very recently in many, many years. That's in general good, opening up a new market for the refined product tanker space, which has a very slow growth rate in the order book and a reasonably good demand growth with ton-mile demand growth as well.
Do you need different types of ships in order to carry product versus those that carry crude? I mean, if you refine jet fuel or gasoline or kerosene heating oil, do you need different types of facilities for that?
Clearly you have different technology that's involved with the crude tanker. There's less on the tank coating side, as well as they're generally larger. Products are carrying parcels that are generally often refined and need cleaner tanks, and sometimes the tank coatings can be so high that these product tankers can also carry chemicals and be extremely versatile. And again, extending ton-mile demand with refinery capacity shrinking in Europe. It's up this year in the U.S. with the Motiva expansion, but again, we're exporting.
Explain what the Motiva expansion is.
The Motiva refinery expansion is the first major U.S. expansion of a refinery in quite some time, expanding refinery capacity in the U.S. Gulf quite significantly. But then all other new expansion of capacity is coming in India, Saudi Arabia, China, Brazil. So in the future, ships will have to go longer distances to serve the same demand, particularly to Europe.
So where's the best place to make some money? I mean, if this big pile of oil, this big oil reserve in Cushing, Oklahoma starts, flows through the Seaway pipeline down to the Gulf, how do investors make money?
I think if you want to get involved in tankers in general, and I think that crude going into the U.S. Gulf is not a huge impact, but certainly not a positive for crude tankers. So the VLCCs and the Suezmaxes, companies like Frontline and OSG will have those ships and probably not be positive for them. That being said, I think they're generally well structured, and OSG I do have an outperform rating on. But if you want to get involved with the product tanker space, again with a very small order book and decent growing demand globally. I know today with the macro concerns it's pretty hard to buy anything, but our favorite outperform rated stock there would be Scorpio, STNG, and they own mid-range MR product tankers that have very high coating ratings, are very versatile, and an excellent balance sheet and ability to grow. And that market is structurally getting better with the long-term rates higher than the spot rates. So that contango is also very bullish today.
Scorpio tankers. Explain this idea between long-term rates and short-term rates, because as shipping companies sign long-term contracts, they could get locked into a price that's low when the spot market is high.
Right. Typically what you see is the spot market being above the long-term market. If you fix your ship or sign a long-term contract, you lower your own risk and you pay for that. In this case, if you want to do a 3-year charter, it's a good 5 to 10% higher than a 1-year contract, and which is also quite a bit higher than the current spot market voyage rate. That's generally bullish. We're seeing oil majors and major oil traders take ships for longer terms now because they see over the very long term a shortage of ships coming and want to lock in a low price. And for the most part, ship owners are now holding off and waiting for better rates.
What about Scorpio? What about their charter book? I mean, do they lock in the rates, or are they all looking at the spot market?
Well, they have quite a bit of spot exposure. They also have some charters, and they do have a portfolio approach to their book. This being said, they're looking at the shorter term market and trying to lock in for the longer term as they go forward. So shorter term right now.
I want to thank you very much. Urs Dur joining us from Clarkson Capital. Appreciate your thoughts on the shipping and the tanker industry and the Seaway pipeline. Have a great trip to Piraeus and the Greek shipping conference.
It'll be very interesting. I hope to report back to you.
We look forward to it.